Hello, this is Tom Pizzuti with Trading in the Mark. Hope you're well. Today I want to take a few minutes to talk about bonds. Bond chart has been my favorite chart for several years now. Let's talk about the reasons why it is interesting to talk about at this point in time and what it might mean in the future. Right now, take a look at the chart in front of you. You'll see that we've had a choppy rise from 2007, which I'm calling this a kind of some degree a fourth wave. That's not important right now, but we're moving up off of that point, and having moved up off of that point, is the move is choppy, has lots of overlap in it. And back in probably this period around here, about 2010 into the early part of 2011, I started really trying to figure out what was happening here. Is that if this is a consolidation pattern, we moved out of the consolidation pattern, well, then this is a mess, because it doesn't really look like we've had anything like an impulse wave up off of it. Is that we can see that this has a pretty clear three-wave move up to here, then some kind of decline, then another sort of three-wave move up, and then we're kind of starting to, around here, was declining again. And it was in this time period that I really started to pound the table to say that, all right, I think I have an idea as to what is taking place, and that this was indeed a correction. There is going to be an impulse built from that correction, but that's going to take the form of a ending diagonal. And an ending diagonal is a wave, a motive wave, but it is made up of three-wave components, and takes place at the end of a larger formation, which really makes sense in bonds, in that even by this time period, in the grand scheme of things, interest rates were fairly low, and obviously been getting lower over the last several years, but even from a larger historical picture, we're already low. So this is really made a lot of sense to think about that we're in some sort of end game, but where are we at in the end game? So I started to pound the table and started to talk about that we were going to have a low here. In fact, did find a low, and then once this low was made, was able to start saying, well, at least we could start building some channels here. We know what the lower channel would look like anyway. And then went ahead and moved forward, and had anticipated a rise. This area in here gave us a little bit of trouble, in that you could see that it was choppy, didn't know if there might need to be one minor new high left in this or not. But in fact, we did finally get it to roll out. We were looking for this low in this area to hold. In fact, did. And we're looking for the market to move higher. And that continued on up into where we're at now. In the most recent history was, again, called for support to be found and have one last move up. Again, that worked out well. The next place had a little bit of confusion, was right here. One, didn't know if this was going to turn into some type of triangle, or so didn't know where to start start thinking about where this impulse began. Did the impulse begin here, or did the impulse begin back here? But that resolved itself. Ended up making a new high. I was a little bit fearful that this might truncate and fail to make a new high. I'll take my hits for that. But I definitely think that it makes a lot of sense to be real cautious with bonds. Now, there's people out there that are pounding the table to say, hey, there's negative interest rates in some other countries. We'll have negative interest rates coming to the U.S. I don't think that's going to take place. It doesn't look like that to me in this chart. It looks like this is a terminal pattern. It looks to be complete at this point. You can maybe argue that this little area right here, this last wave, may not be fully complete, that there might need to be one tiny more high left in this. I don't think that doesn't look like that to me on lower time frame charts, things like a daily. But if there is going to be a new high or maybe a potential lower high, I'd say the right place for that would be October. On this chart, we have a pretty long cycle shown here. This is a 43-month cycle. We've already are in the declining phase of this cycle. But the next weekly cycle, the cycle that is right under this one, next inflection point for it is right in October. So if we haven't already had the high now, which I think there's a decent case for, then it will probably it would be in October. So I don't know if October is going to be turned into a high, or if October turns into being a lower high, or even in fact that October turns out to be some type of cycle low. If you've done any kind of cycle work, you know that cycles can invert, so it's difficult to know whether it's going to necessarily be a high or not. We can take a look about how that cycle has been performing in the past and try to make some guesses as to whether it could invert or not. But I usually try not to do that. I just pay attention I usually use cycles just for timing purposes, not for the direction of the move, unless the cycle is very, very regular. But that doesn't matter right now. So, looks like if we have a high, what would that mean? Well, since this is an ending diagonal, ending diagonals tend to, once they break support, which would be this trend line right here, and this could be, sometime next year, could be even late next year. But whenever this trend line does break, they tend to break quickly after the first break. So there could be a break, a consolidation move that could last several months, maybe half a year, come back and test the break, and then the next move is very quick. Now, considering that this whole advance has taken nearly 10 years, I would expect that this break that if it does break, when it does break, that the break is not going to take 10 years to come back to the origin. It's going to happen a lot quicker than that. Certainly will happen, I would no less than 5 years, and I think it's much more fair to say that it probably happens in 2 or 3. And that's just how these things work. Declines in general happen quicker than advances, and declines out of diagonals happen to be one of the very sharpest. So that really doesn't tell us a lot in the near future. I think that this is certainly not any kind of forecast for a crash in bonds. I don't think we're not anywhere close to that. But I do think the turn, if it isn't here now, is soon in front of us. Like I say, a month or two away. At which point we should expect bond prices to fall. There will be, fits and starts, zigzags. It doesn't move in a straight line until support ends up being tested. Once support is tested, then and broken, well, that's when the real game begins. And that's probably I would say that is probably a year out, or maybe a little bit more. But it certainly makes sense to start I think maybe consider positioning for a turn. This has been a trade that there's been, and I'm one of them that I think that this is debt in general is in a bubble. But hey, these things keep going until they break. I'm just saying that we're at a point to where it definitely makes sense to shop for a turn. Certainly, one of the things I keep saying is, bonds are not for widows and orphans. Definitely, bond prices could fall from this level and fall for a many, many years. Again, there'll be ups and downs and zigzags, just like in everything. But I do think that we're at a pretty important inflection. I hope the summer's gone well for you. People are going to start getting back into the trading mode. Kids are going back to school. People are back from their vacations. This next month should be interesting. Wish you well. Good trading.